to be on this session with me. I know how hard it is with life, work, family, and everything. It's quite tough to make out that time during the weekend, most especially when you're supposed to be chilling, having some fun time, resting time, but you're spending it right here. And I appreciate you. And I'm going to make sure that this is going to be worth your time. And every single person, both people that are in my one-on-one mentorship, both people that have been in my mentorship, whether it's one-on-one group mentorship or just watching my videos in the group or on social media, or even who has gone through my course. I just want you all to know that today I'm going to share with you all a lot of knowledge, a lot of things that has helped me personally as a trader. And I believe these things are going to help you. So if you're someone you've been blowing your accounts and you've been struggling with finding consistency, everything you're trying doesn't seem to work. You try different strategies, try different mentors, and nothing seems to be working. At some point you're feeling like maybe trading is not for you. Maybe you just need to give up on trading. I just want you to know that after today's session, you're going to have a lot of knowledge that will support you and guide you to know the next steps you need to take in your trading journey. So I'm gonna share my screen right now, and so we're gonna start with can everyone see my screen?
Yes.
All right,
Yes, we can see it.
perfect. So I'm just going to write on my screen. Now, there are a few things. I'm just going to keep this as simple as possible. So we have very few things for you to focus on. Now, when it comes to trading, the first thing you need to understand before you trade any specific pair is what is the long-term trend and what is the short-term trend. Now, the reason why this is important is because the long-term trend could be bullish, but in the short term, the market could be giving you sells. And if you don't know how to take advantage of that short-term trend, taking trades off that short-term trend, you'll see that you'll literally be on the sidelines for a very long time. Now, and I'll show you things that you need to look out for when you think price is ready to continue with the long-term trend. So I'll write it here. So the first things you want to understand with any pair you're trading is what is the long-term trend? So the first one is what is the long-term trend? And the second one is what is the short-term trend? Now, once you understand the trend, what is the long-term, the short-term, now you're looking for confluences to align for you to take that trade. Now, in a situation where you are looking for confluences to align for you to take a trade, to align with the long-term trend, you want to see something like a daily BOS. Yeah, I'm basically trying to let some people in, and each time I do that, it just messes with the trading view. So now for the long-term trend, what you want to see is a daily break of structure for you to say, yeah, now it's time to focus on that long-term trend. So let's say, for example, you're bearish on a specific pair. Let's say it's dollar or euro, or let's say you're bearish on euro. This is just an example. And you're seeing that on the long-term time frame, like 12 months, 6 months, 3 months, you're seeing that price is consistently creating lower highs and lower lows on 6 months, on 12 months, on 3 months. You're seeing that price is consistently giving you those lower highs and lower lows, even on the monthly. Now, on the short-term time frame, like 1 hour, 15 minutes, 4 hour, for price to create a lower high, before this next lower low. It's going to trend to the upside, isn't it? It's going to be creating higher highs and higher lows on the smaller time frame, right? It's going to be creating higher highs and higher lows until you see this daily breakup structure. And now you can now start looking for sells to continue with this long-term direction, which is bearish. But meanwhile, price going to the upside, creating this higher highs and higher lows on the short-term time frame, like 1 hour, 15 minutes, 30 minutes, 1 hour, 4 hour. If you stay on the sidelines, this move could literally take months. So that means if you don't know how to get into the market and take a trade to go to that upside, if you don't know how to do that, that means you are literally not going to make any single money. And if you now want to trade full time, be a full-time trader where you're literally dependent entirely on trading to pay your bills, that means you're not going to make any money to pay your bills. So today we're going to cover how you can understand the long-term trend, know which area to start anticipating for that trend reversal, and how you can also use the short-term trend to your advantage to take those trades like this. Does that make sense, everyone?
Yes.
Awesome.
Yes, sir.
So let's go to the charts. After this, then we'll go through other things I want us to talk about. But I just want us to take it step by step so you don't get confused. So I'll take this off. And if you have any questions, I'll highly recommend you can write it down. Once we finish the session, you can ask a question and we can go over that as well. Every single question is allowed. So now this is a typical example. If you look at DXY, you can basically see that this is 3-month time frame and this is very bearish, creating lower highs and lower lows. Lower highs and lower lows, right? Now imagine that you're bearish on DXY and you want it to continue to the downside. That means you're literally going to be on the sidelines for years, waiting just to sell, to continue lower. This is where traders get it wrong because now you're saying that 3 months, 6 months, 12 months is bearish. Now you're looking for sells. When the market is showing you clean that in the short-term perspective that we are bullish. So all you should be looking for is key levels to buy on the short-term perspective, key levels to get out. Now, what are those key levels? Those key levels can be inefficiencies, they can be liquidity zones, they can be a previous high, a previous low, depending on that position. So an example you can see right here, this is a key level. We have an inefficiency, a fair value gap, or an imbalance, depending on what you call it. They're all the same. This is a key level where you want to see a mitigation. And then once you see a mitigation inside here and you are looking for the daily break of structure inside this position for you to now start looking for that continuation trend to the downside. Now let's go to the daily time frame and look at what that looks like. Now this is the daily time frame, and you can see how price came into that position, that inefficiency. And after we came into that position, you can see how nicely the market was trending to the upside, creating highs, lows, and overall, I'm only interested in the swing highs and the swing lows. These other ones, the higher highs and higher lows, they are awesome. But the reason why I'm not interested in the higher highs and the higher lows is because price can still break through the higher low and still run the highs. But if it breaks a swing low, that is a significant break of structure. Now, some of you know the change of character and the market structure shift or break of structure. The change of character is on the smaller time frame. The break of structure is on the higher time frame. So if the market changes structure on the daily, on the weekly, on the monthly, that is the break of structure. If the market changes structure on the 5 minutes, 15 minutes, 30 minutes, 1 hour, that's a change of character. It doesn't mean that the structure has shifted. So right here, this is our swing low, this is our swing high, and you can see how right here, the moment price broke through this low, that is our significant break of structure, showing us that long term, the market wants to go straight to the downside. What are you going to do with that information? What you're now doing is you're going to the higher time frame. You're going to the higher time frame. You're seeing this is the daily. Scale up to higher time frame. You can go to the weekly, you can go to the monthly, and look for inefficiencies or liquidity zones resting around this position where price will come back into for you to sell it again. Once you sell it and it's going to the downside, everything is working in your favor. Once you come into the chart every single week, look for areas of interest price can come into like this. Price can come into like this. Once price comes into those positions, you don't need to jump in immediately. Wait for mitigation, wait for a lower time frame break of structure like this. Now you're looking for an entry to continue to sell. An example, you can see after this break of structure, the next thing we want to do is we want to go straight to the weekly, and we want to look for inefficiencies that price could come out, that price can come into, mitigate the continuation for us to start looking for sales. And if you look at this right now, you can basically see that we have just one inefficiency here. That's all we have right here. Just one point of interest. So all we do is to mark that point of interest and wait for price to come in there. And then we look for those lower time frame break of structures. It can be a 1 hour break of structure. It can be a 30 minutes break of structure. It can be a 15 minutes break of structure. Once we see that, we're taking our trades. This is for long-term trend. After this example, I'm going to go through this same thing on a different pair, and then we'll go through short-term trend, what that would look like. So right here, you can see how price played around. You can see how long it played around. Eventually came into that position. Look at this. This is a low. This is a high. And right there is a break of structure. Price came up. Inefficiency. That's a key level for you to sell. Sold off. Inefficiency again right here. Another opportunity for you to sell again. Is it making sense? Does it make sense, everyone? If it doesn't make sense, you let me know.
It makes sense, sir.
Awesome. So this is an example for long-term trend continuation. So let's have a quick look on a different pair on the same thing. On a different pair, let's look at, so let's look at, so let's look at the different pair that is not euro. I can use euro, but euro is pretty much inversely correlated to dollar. So it's pretty much like I'm doing the opposite of the dollar. Well, I can just use that because I think a lot of you here trade euro. So let's look at euro. Now on euro, you can basically see that long-term perspective, euro is bullish, consistently creating higher highs and higher lows. Now you can see that if you were saying, yeah, euro is bullish, so I'm only going to buy euro, you will see that during this period lasted from 2008 until 2022. So that means if you were only interested in buying it, yeah, you're still going to make money. But if you're trying to buy the low, the bottom of the market bottomed out around in 2022. So that means it's literally giving you opportunity for sales, opportunity for buys here, sells here, buys here, sells here. How can you be able to get into those buys and sells? It's very simple. You can use higher time frame points of interest, inefficiencies, and you can even add the Fibonacci to help you with that. You can see right here, this is an inefficiency. We came into that inefficiency and look what the market did. It gave you opportunity to buy. And look what it came into on the higher time frame. It came into another inefficiency on the higher time frame and gave you another opportunity to sell. And after that, the market rallied again into this inefficiency up here and gave you another opportunity to sell from here. came to the upside. If we take this to the lower time frame, like monthly or weekly, you're going to see there's going to be an inefficiency here. So let's take it to the weekly time frame. Now, this is the weekly time frame. And you can see right here, this was the price action. Can you see that price came up? Look at what it came up and mitigated. A weekly inefficiency. And after that mitigation, it went to the downside. And when it came down here, it came down, it took liquidity, rallied to the upside, broke structure here. And if you look at this, this is weekly time frame, and this is a weekly break of structure down here. And the moment you're seeing that the market is showing you a weekly break of structure down here, and it's rallying to the upside, breaking structure, coming down here, retesting inside an inefficiency, you don't even need to jump in immediately. You can literally wait for a 1 hour break of structure down here. And once you see that 1 hour break of structure, you can look for a buy. And you can target low resistance liquidity, or you can target an inefficiency. If you take this to a lower time frame, you'll see there's going to be another inefficiency resting somewhere around here, which attracted price to come to the upside. So whilst the market is still trending up, down, consolidating, you're still using those higher time frame break of structure to anticipate for the next drawn liquidity, whether it's going to be to the upside or to the downside. So let's go to the monthly. Now, on the monthly time frame, you can basically see how we were consistently creating lower highs from here, lower lows, and lower highs, and lower low, right here, lower low. And you can see that price broke this structure completely, and it closed below it. So that's giving you a telltale sign. There's a very high chance that this high will stay sustained. So price coming up here, you are confidently looking for a sell. Now, you don't just jump in. You can wait for a lower time frame break of structure. You can wait for a 4-hour break of structure. You can wait for a 1 hour break of structure and use that for a sell. And if you use your Fibonacci to add spice to it, if you use the Fibonacci from the range high to the range low, you can also see that that is an extreme premium zone, showing you that if this area fails for sells, that means price wants to take this high. So this is the last line of defense for you to take a sell. So this is basically how you can anticipate for those long-term trends, continuation. And once you see that the trend has shifted, whether it's weekly break of structure or daily break of structure, once you see that, you follow that trend. Don't try to trade against that trend. You can see that in this case, look at how price is trending to the downside here. Consistently trending to the downside on the weekly until we broke structure here. After breaking this structure down here, that's the market giving you a telltale sign that your focus should be on buys. And can you see how buys has always been favorable? And even when price came down in here, buys. So if for any reason you see this market break a weekly low, that's the market giving you a telltale sign that the buys are low probability. So you should focus on the sells. But for now, can you see any weekly break of structure to the downside here? No, there isn't any weekly break of structure here. So that simply means that buys will always be higher probability. In as much as we are inside this consolidation, price is consolidating, going up, going down, you're still going to be able to catch short-term buy opportunities. You're still going to catch short-term buy opportunities. Look at this inefficiency. We came into this inefficiency, the market still gave you buy opportunity. So the buy opportunities are still going to be higher probability eventually. Even if price goes to the downside, runs this low, if you still see those breaks of structures, whether it's on 4 hour, 1 hour, you'll be surprised. They'll still work and give you a 1:2. Easy. Now, if you're still struggling to consistently make money, what I would recommend for you to do is you can have a specific target of a 1:2 for now. Just quickly focus on the 1:2. Now, the reason I'm saying you should strictly focus on the 1:2 is because Some of you don't really understand that this market has a daily average, a weekly average, a monthly average. That is why some of you will hold a trade until it reverses on you and takes your stop because you didn't even know that that pair has exceeded its daily average or weekly average or even its monthly average. How do you even know this? How you know this is by using this ruler right here, going to the weekly, going to the daily, going to the 4 hour, measuring the biggest candles and the average candles. An example is you can see right here, this is the biggest candle we have on euro. This is one of the biggest candles and it's 4.74%. And this is in 1 week. And then the next one we have right here is 5.47%. And this is also in 1 week. Now, can you notice that there's not really many candles that has printed this level of percentage in 1 week? This one right here printed about 4.68%. So this is giving you a telltale sign that if you're in a trade on Europe, and if for any reason that weekly candle gets up to 4%, you shouldn't even be in that trade anymore. There is no reason why you should be holding in that position anymore. You need to get out with your profit because the market could easily get exhausted. There's what we call an exhaustion zone. The market could get exhausted
That
and pass on you.
you can go and do there.
So, so now, if you look at this, you can see that on averages, the average weekly candles here is delivering around 2%, 2%, 3%, and let me just look for another one, 3%. So this is already showing you that, let's say you're on a trade, maybe you're on a buy or you're on a sell for whatever reason you're selling it, and you're seeing that price is going in your direction, and the weekly candle is already printing 2%, 3%. You need to start taking profits. You need to start trailing your stop loss using 5 minutes time frame because price can easily get exhausted and it can reverse on you and you lose all your profits and you will keep making money, losing money, making money, losing money. A lot of you don't know this. And that is one of the reasons why you're still struggling. But if you can understand the pair you're trading, every pair has its averages. Euro has its average percentage it can do in a week and in a day. USD card has another different averages that it can do in a week and in a day. Gold as well has different ones. This is a typical example of literally current price action. So this one right here, long-term perspective, I'm bullish on this. I want to see it continue to the upside. On the weekly perspective, we still have inefficiencies down here, and price can still decide that it wants to come down there. But it isn't a guarantee, and we're not trying to predict what the market is going to do. When we go to the daily time frame, we're still very much bullish. I'm not seeing any significant daily break of structure to say price wants to dump and go bearish. When we go to the 4 hour time frame, you can see that on the 4 hour time frame, we created a high, we created this low, we created a new high, and right here, this is a break of structure on the 4 hour time frame. This is giving me a telltale sign that on the short-term perspective, price wants to have a retracement before a continuation. So that means I'm not going to be too eager to be jumping into a buy and holding the buy for a long time. Now, if price comes into this position, because this is a counter trend opportunity, all I want to see is the same time frame break of structure. This is 4 hour break of structure here. Price coming here, I want to see another 4 hour break of structure from here. And you can see that this created a high, created a low, created a high, broke structure down here. Coming up here, I'm looking for a sell. While I'm looking for a sell, now this is where it gets interesting for what I just said about exhaustion zones, not knowing when the market is exhausted. If you go to the weekly time frame, you can see that this weekly time frame, the market has already gone to the upside, printed about 6% to the upside. Now, someone who was in a buy down here, holding and looking at this weekly candle, delivering a 6% move to the upside. Can you notice? Let's look at the candles. How many times has gold delivered 6% on a 1 week candle? Here it delivered 9%. Here it delivered 4%. Here it delivered 3%. This is a small candle. We're focusing on the big candles. Here it delivered 4%. And this is another big candle. Here it delivered 9%. Let's look for another big candle. And right here it delivered 5.5%. Now you can see that the big impulsive candles on gold are delivering between 5% and 9% maximum. So price delivering a 6% on one candle is giving you indication that you need to exit on that buy. Don't keep holding that buy. For me personally, if I'm on a buy on gold and I'm seeing that the weekly candle is up 3%, I'm trailing my stop loss with the 5 minutes low because anything can happen from there and it will reverse and wipe you out and you lose every single profit you made. And this one already delivered 6%. You don't have any reason to buy it anymore. There's no reason to buy it anymore. Absolutely no reason to buy it anymore throughout the week because of that 6% move to the upside. Now, coming to sell it, you can basically see that these are daily candles, and you can see that these daily candles on the other end, you can measure the averages. You can see that the average candle here is 2%, and this one 2%. So the average candles on the daily time frame for gold is around 2%. This one is 1.7%. So 2% should be your maximum average daily candle. So if you're on a trade on gold on the daily time, you're looking at the daily candles and you're seeing that the daily candles are printing 2%, you shouldn't have any reason still holding on to that trade. You need to be scaling out profits because anything can happen. The market will reverse on you and run your stop because it has exhausted the daily average and you're still holding it without realizing that there's an average that the market can go within a day, a certain day, and within a certain week. Look at this right here. You can see that this candle delivered a 4.28%. You have no reason still holding that sell. You need to be out of that sell. In one day, one daily candle already delivered 4.28%. Most people don't know this. You are never going to see anybody talk about this on YouTube, Instagram, nobody. It's going to tell you this. And I'm giving you this information for free today. Use it wisely. And I can assure you, if you can focus on these things, understand the long-term trend, know when to focus on the trend, know when you need to be counter-trending. In this case, I only took this counter-trend opportunity because I saw same time frame break of structure. Now, if I'm looking for a sell and I'm taking that sell, I'm watching this inefficiency and I want to be out from here. And the reason I want to be out inside here, I don't want to hold the trade past this inefficiency because the market could mitigate this inefficiency, reverse, and continue higher because we are bullish. As much as we took a sell and it worked out in our favor, the market still remains bullish till further notice. The market still remains bullish. It can still open tomorrow, tomorrow night, and still continue high. So now let's go to the next thing we're going to talk about today. Let's go to how you can use the short-term trend in your advantage using, let's use USD card for an example. Now, when it comes to the short-term trend, you can basically see on 3-month time frame, you can see that this one right here was trending to the upside previously, creating higher highs. And this is the swing high, this is the swing low, and this is the swing high. And right here, we'll have a break of structure. This is a major 3-month time frame break of structure. So that's showing you that long term, we're bearish on USD CAD. So all we're looking for is which area of interest are we going to keep shorten USD CAD to the downside. So that simply means that when you see a daily break of structure to the downside or weekly break of structure to the downside on USD CAD, your focus should be on selling it. Example, you can see that after we topped out here, look at right here, this is an example. After we topped out right here, you can basically see that price broke a daily structure. And why did it break a daily structure? Did it just stop out and all of a sudden start breaking a daily structure? You can see that we came into a 6-month inefficiency resting right here. And also, if we use our Fibonacci, you can basically also see that that Fibonacci also aligned with, this is our extreme premium zone. And this extreme premium zone, you can basically see how price came up to that position, tapped that area very nicely. And after tapping it, all we just want to see is a daily or weekly break of structure, and our focus will be on looking for sell opportunities. And right here is a daily break, and after that, we're looking for a retest. All you're looking for is sells. And while you're selling, you still go to the higher time frame, and you need to know where we are in the marketplace. And right here, if you go to the weekly, you can see right here, this is weekly, this is a weekly low, and this is a weekly high. And price came to the downside, came very close to the low, came very close to take the low. You can see if you use your Fibonacci, you can also see that this is the extreme discount right here. And after it came to that extreme discount, the markets started reversing and going to the upside. Now, there's something I need you all to understand, right? I know a lot of the times you all hear about institutional trading, SMC, and all the rest of them. And I'm not dissing any of these strategies. I trade smart money concept myself. But one thing I need you all to understand is the way we think that the institutions trade is not how they trade. Everything that has been sold to us, including myself, telling us that this is how institutions trade, it's all a lie. The institutions, they don't trade with the trend line, they don't trade with the SMC strategy, they don't trade with all those strategies. These people, they can already see what we're doing. They own the brokerages. They can see our stop losses. They can see when we are buying. They know where we're getting in. They can see that over 90% of traders lose. When they're looking at their brokerage and they're seeing that 70, 80, 90% of traders are buying euro or buying gold or buying any asset class, what they do, it's all a numbers game. They need to figure out where is the market right now. This is an example. If the market is at an area where it's never been before, or it's a really very expensive price, or at a very cheap price, and the retail traders are trading in the opposite direction, they will start trading opposites to us. Because it's quite obvious that if 90% of traders fail, and you're seeing that 90% of them are buying, it's quite obvious for you to sell. So just bear that in mind. And the reason I'm saying this is because a lot of us are making our trading decisions based off these strategies. Now, I'm not telling you that my strategy is the best or anything. I'm telling you this is something that has worked for me. Saliu, can you please stop joining on the screen? I'm just gonna remove that. If you have any questions, you can let me know. You can just write me on the chat or something. So now,
Sorry, sir. I said mess up. Sorry, sir.
no worries at all. So now, going back to what I said about this being a numbers game, it's all a numbers game. When the market is too expensive, the institutions, they want to buy, they want to sell. When it's too cheap, that's when they want to look for buys. An example is this right here now. After we saw that daily break structure, the market went to the downside. It came down here really cheap. It was very cheap. A lot of them wanted to buy it for a long time, looking at it at an extreme discount. That is the market giving them opportunity to buy. Buying from down here, the market is already hitting an equilibrium, and inside the equilibrium, what they're going to do is they're going to start offloading their buys, closing the buys, because now the market has gone from being too cheap to now being at premium. So if they bought down here, let's say they put in XYZ amount down here, price hitting this level, they are scaling out at least some percentages to secure this trade so that it doesn't go from profit to now a losing trade. So I think someone has a question or something. Can I see your strategy entry checklist? Yeah, we're going to come into that. So for now, we're just talking about the long term, the short term, and after that, we're going to talk about the entries, and then we'll talk about exits. So just bear with me and just have a little bit of patience. So now, right down here, despite the fact that we're seeing that the trend on the daily, the market was trending to the downside, how do we know that the trend has shifted and focus only on buying it on the short-term perspective instead of focusing on just trying to sell it and keep getting wiped out? We look for the daily break of structure. And down here, you can basically see how price was going to the downside, creating lower highs and lower lows until we saw this break of structure here. Now, this right here wasn't a break of structure. It was a complex break of structure. The reason for that is simply because there wasn't a candle closure above the wicks. Now, if you look at this, this was the wicks. This is the wicks. And you can see that this wasn't a candle closure. And this candle right here, even though it closed above there, you can also see that it didn't close above the wicks. I would prefer to wait for it to close above this wicks. And this one, this is a bearish candle. So even if it closes above, I'm not going to regard that. I want to see a bullish candle close. And none of this one's closed. And this one, it closed above this high, but it didn't close above here. So it needs to close above this newly created high and wicks. This is the one that eventually closed above. And you can see that right there. So this is my break of structure. Now, despite the fact that this is my break of structure, I'm still not going to just jump in right there. I'll still want to see that retest inside here. I want to see that retest on this high. That's why I want to see that retest. And then I can use inefficiencies as my point of interest. Right here, this is an inefficiency as my point of interest. Once price mitigated, I want to look for buy opportunities like break of structure on 30 minutes or 1 hour. If I see that from down here, I'll be looking for buy opportunities. Now, on the short-term perspective, what I do is I stay on the daily time frame. In order not to confuse yourself, it's better to just stay on the daily time frame. You can still do this on the weekly. And you can see that on the daily time frame, the market is consistently giving you higher highs, higher lows, and eventually right here created another higher high, created a higher low, created a higher high. So that means price coming down here, your focus should be on looking for areas of interest for you to buy. And you can be targeting a 1:2, get out. Don't hold it for too long because you are trading against the long-term trend, which is to the downside. You're trading against that. So if you're trading against the trend, the best thing is to do target 1:2, maximum 1:3. Try to measure the weekly, the daily averages. Now, some of these pairs move very slower than the other. We've already looked at gold, and you saw that the daily average, the weekly average on gold is around 3-4%, sometimes 5%. Weirdly, sometimes it does 9%, but that is one out of months. That happens once in a very long time. So you shouldn't be focusing on that. Now, if you look at euro on the other hand, euro's daily and weekly averages are also different. On a daily perspective, euro can do between 1% to 2% maximum. So that means if you're on a trade on euro and you're looking at the daily candle, it's already printed about 1.5%. You need to start taking profit, trailing your stop loss to massively in profit. So that trade doesn't reverse on you and wipe you out in a loss. Another example, looking at this is USD card. And on USD card, let's look at the biggest bullish candles. And this is 0.58 on a daily candle. And this is one of the biggest candles. And this is 0.61. This is one of the biggest candles. That's already giving you a telltale sign that if you're on a buy on USD card and you're seeing that the daily candle has already printed a 0.5% in that day, you need to start scaling profit and trading your stop loss into profit because that trade can easily reverse on you, get exhausted, run your stop loss, and now you end up losing all the profits. I don't know if this is making sense, everyone.
Yes, sir.
Makes sense.
So now let's go to the entry criterias. So I believe everyone understand how you can focus on how you can use the long-term trend to your advantage and the short-term trend as well. For the short-term trend, focus on the daily time frame, on the daily time frame market structure. If you're seeing that the daily time frame is giving you higher highs, higher lows, all you have to do is look for points of interest. If you want to make it easy for yourself, for you to be profitable as quickly as possible, use the higher time frame points of interest. A lot of you are playing around on the lower time frame and wondering why you're not seeing the kind of results you want to see. If you focus on using higher time frame points of interest like daily, 4 hour, weekly, monthly, if you're using a fair value gap or an imbalance from 4 hour, daily, weekly, monthly, you will see that your trading will change. You will not be in too many trades, but each trade you get into will be higher probability. Even when you're wrong, you'll be surprised that if you're targeting that 1:2, price can easily give you that 1:2 before it reverses. Example, look at this. Now, you can see that right here we have weekly inefficiency. Let's say you use this weekly inefficiency right here for this weekly inefficiency. Let's say you used it for an opportunity for a buy. Can you see how that worked out? And it gave you a trade. That could have easily delivered a 1:2. Look at this one here. If you use this weekly inefficiency, that would have easily delivered more than a 1:2 inside an extreme discount. So someone asked a question, what time frame should an intraday trader focus on? Now, if you're an intraday trader, the time frame to focus on is focus on the daily trend or the 4 hour trend. Use 4 hour inefficiency, daily inefficiency as your point of interest. Now, subsequently, you can still have some level of confidence to go to 1 hour. But the reason why I wouldn't recommend you to go to 1 hour now is because you will hurt yourself eventually. Because when you go to the 1 hour, that means you're using a 1 hour inefficiency or fair value gap as point of interest, which means you have to use a 5 minutes break of structure. And some of you don't even understand the 5 minutes time frame. And you can go in there and not even know what is the break of structure. Some people here who have been in my program, they understand how to do this. Like John, he knows how to do this. And John has been in my program 3 times, 3 months. So he understands how to use the 1 hour fair value gap, wait for 5 minutes break of structure, and get in. That's how he was able to pass his funded challenge. First trial. True or false? John, can you hear me?
True, true, sir. Yeah. Yeah. I can hear you, sir. That's true.
So it will take some time. Don't be in a rush. Some of you want to get to where you're going to instantly. That's not how things work. Everything great will take you time. Everything great. The question is, how badly do you want it? If you want it so badly, you have to keep showing up. You have to keep trying. You have to keep trying to figure out what did you do wrong this week? What did you do right? A lot of people focus too much on criticizing themselves on the things they did wrong without realizing that you can also dial in and focus on the things you did right, even if it's just 1% thing you did right. Dialing on that 1% thing you did right, one trade you took that went well. Ask yourself, why did this trade go in my direction? Why is this trade a winning trade? Figure out the reason why. Document the reason. Focus on just that. Whenever you see that, take the trade. This is why some traders that trade the trend line, trade the double bottom, double top. This is why some of them make money. because they are waiting for that exact same pattern every single time. Now, I don't recommend you trading those patterns. I don't trade them myself, but I'm just giving you an example. So, going back to what we're talking about, you can already see that this is a weekly inefficiency and price mitigated it, reversed, gave you a trade. Now, if we go to the daily time frame, you can see on the daily time frame, the trend is bullish. This trend is bullish, giving you higher highs and higher lows. So that's already giving you an indication that highs has a high probability to play out in your favor. Now you can go to like the 4 hour time frame and be looking for areas of interest where you can buy. And now add the Fibonacci to help you know which area would be the highest probability to buy. This right here, this is your Fibonacci. This is equilibrium. Anything below equilibrium is discount. So all you're looking for is point of interest inside the discount zone where you're going to buy. Inside this discount, that's all you're looking for. You can look at this price action here. We have candle without wicks, which is liquidity. And there's also remnants of this inefficiency, Western Rider. Can you see that imbalance? There's an imbalance here. Price coming into that imbalance. You don't have to randomly just jump in immediately. The person that asked me my criteria for looking for entries, that is what I'm explaining right now. I want to buy from a discount if I'm bullish. I want to buy when it's cheap. I want to buy from an imbalance, a higher time frame imbalance. It could be a 4 hour imbalance, daily imbalance, weekly imbalance, or monthly imbalance. Once price mitigates that imbalance, I'm not going to just jump in immediately. I want to wait for my time frame break of structure. It could be a 15 minutes time frame, it could be 30 minutes, it could be 1 hour, it could be 5 minutes. The next thing I do is I want to align the time frame. Already, you can see this is a 4 hour inefficiency. I can go to 1 hour to see if there's an inefficiency aligning with that 4 hour imbalance. And in this case, you can see that we have a very small imbalance here. There's an imbalance in here. So that means the 4 hour imbalance aligns with a 1 hour imbalance. So I can confidently use a 5 minutes break of structure to take this trade for buys. So we go to the current price action, and you can see right here, we go to the 5 minutes, and you can see right here, look at that imbalance right there, the blue lines. Price came into that position, trending to the downside, creating lower high, lower low, lower high, lower low. And then right here is a break of structure. If I remove this, you can see that break of structure there. I'll zoom it in. That's a break of structure. Now, some of you can decide to use this imbalance as your entry, place your entry inside the imbalance. You can decide to use the 50% of the imbalance. You can decide to use the high. For me personally, I would recommend using the high for now. Subsequently, when you build confidence, you can decide to play around, use maybe the 50%, but never use the open of the imbalance because sometimes price will intentionally not come there. You can see this example. If you use the open of the imbalance, you would have missed this trade. Or if you use the 50%, you would have gotten it. If you use the close, you would have gotten it. If you use the high that got broken, you would have gotten it. For now, stick to using the high as your entry. You place your entry on that high. Once you see a break of structure above that high, place your entry right there. And the next thing you do is your stop loss will be this low. Add extra pips below. Don't ever place your stop loss directly on that low. The reason I say this is because sometimes there will be a lot of manipulation and price will come very close to your stop. Your broker can easily liquidate that position, even though it doesn't hit your stop. This is why some of you get into a trade and the trade goes to your direction, everything is right, but you're wondering why you still took a loss. That's because you keep making your stop loss too small. I used to do that when I started trading newly. I used to think, oh, it's nice to have a 2 pip stop loss, 3 pip stop loss. I'm looking for the smallest stop loss. Don't do it. That is one way ticket for you to be unprofitable forever. Guaranteed. This is where the low. Add extra pips below. This low right here is 8.9 pips. It's ideal to add between 3 pips extra or 5 pips. In this case, let's just add 3 pips. That puts it at 11 pips. Your take profit position, exit. Now, when it comes to the exit, there are things you need to note. First, understand the daily averages of that pair and the weekly averages and where we are. Number two, the inefficiency or the fair value gap or imbalance. You can use that as your take profit. You can also use liquidity, low resistance liquidity as your exit as well. So these two can work. Fair value gap, imbalance, low resistance liquidity. But make sure each pair you're trading, you understand the daily averages and the weekly averages. Don't just choose any random pair. As much as this strategy can work with any pair, whatever pair you've decided to trade, study the pair, understand the pair very well before you start trading that pair. If you don't understand the pair, don't put your money on the line on that pair. There's a very high chance you're going to lose. Always remember this. The market was rigged for us to fail. It was not created for us to win. It was made to make sure we blow our accounts, we lose all our money, we give up. So that means for you to win, you have to think outside the box. You have to do what other traders are not doing. What are other traders not doing? They're not getting the right education. Other traders are going to YouTube thinking you're going to watch your way to profitability. It can happen in 5 years or 6 years or 7 years. I have a cousin who's been trading for like 10 years, still struggling with the same things. And that is the thing. If you don't have a well-defined understanding of trading, the things you need to focus on, and you think you're going to watch your way to profitability on YouTube, it can happen to you. You can watch and watch and become profitable, but it will take you years, so much time that you could have focused on one strategy, one person, guide you, show you the step-by-step process, try it out, give it time. Every strategy, most strategies work. Most of them work. The only problem is the trader. The trader is always trying to do things that will make the strategy not work. Psychology, emotions. Sometimes you saw the strategy on YouTube, now you think you understand everything about it. No, you don't. Because the person that posted that video is not going to give you every single thing on that video or those videos. They will never give you everything. They will only give you what they can at the moment. So going back to the exits, focus on the daily, weekly averages, use an inefficiency or imbalance, use the low resistance liquidity as take profit. Example, right here, this is low resistance liquidities. You can use that as your exit, take profits. And if we go to a higher time frame, you can also look for inefficiencies as well. And we'll have right here, this is also an imbalance. And let's go to 4 hour. Also have, this is low resistance here on, right here, this is low resistance. You can use that as your exit. And we'll also have remnants of this fair value gap here. You can use that as your exit as well, right here. And right here is also low resistance liquidity. And you can use that as your exit. And you can basically see that if you used pretty much this or this or that, the market would have smashed your take profit and you would have been out of this trade. And it's a 1:3.6. Now let's go to re-entries. Let's say you wanted to get a re-entry. Maybe you missed the first entry for whatever reason and you wanted to get a re-entry on the trade. You can literally use the same time frame break of structure and get in again. Or maybe you got in the first entry and you want to get a second entry. You can see that after this break of structure, or maybe after this break of structure, you weren't even confident to take this trade. You're still on the sidelines. You want more confirmation. This is what you do. You can wait for same time frame break of structure. Price came down, created another low, created another high, created another low. You just want to see a break of structure on 5 minutes here again. And right here, you can see we broke another structure, broke structure here. Second time, place your entry on that high. Stop loss this low, add few extra pips below. That's your second entry. That's And right here, this is the low, 5 pips. Now, because this is 5 pips, I wouldn't recommend any of you using 5 pips as your stop loss. As much as this worked out, and it would have been an amazing trade, but I would never recommend any of you using 5 pips. The reason is because your broker can easily manipulate this and it will take you out and be a losing trade, even though it wasn't a losing trade. So make sure you add few extra pips below. So this is 5 pips. I would rather add at least extra 3 pips below. Give it some room. Let the market play around. So your broker doesn't just wipe you out. Now you can see that the first entry delivered a 1:3, and the second entry delivered a 1:5. So even if you didn't take the first entry and you took the second entry, you would have still made even way more money. And you can be risking very less and still be making really reasonable amount of money. So I don't know if this makes sense. Does it make sense, everyone?
Yes, sir.
Yes, sir, it makes sense.
Awesome. So, so now I've covered the criterias, focusing on the trend, entries, how you get in, using inefficiencies, buying from discounts, and exits as well. I've talked about exits, using imbalance, using low resistance as exits, understanding the daily range. So let's look at the daily range in this one. Excuse me. Now, can you see that this candle, you bought from down here? Remember, USD card. I said the daily range of USD card, if you're on a trade intraday, and the daily candle has already printed 0.5, you need to be taking profit, moving your stop loss. Now look at this. This is 0.37. And then the next day opened, even though the market rallied again the next day to 0.43. Can you see what happened eventually? It started retracing. So that means even before that 0.5, you need to be looking for your exit. Now, despite the fact that it didn't reverse, it was just a slight retracement that could still continue higher or maybe lower. Nobody knows. But can you see that if you were nimble, targeting your 1:2, 1:3, you would have been out of this trade here before this whole consolidation. That's why you need to remove greed. Just target 1:2 for now. Remove greed. Your job right now is not to become a multi-millionaire. Your job now is to understand what you're doing first. Understand it first. Ask yourself, if you've got a job right now, if you, let's say you wanted to work in an oil company or whatever, and you got a job right now today, would you just go to your boss and tell them, you know what, I want you to increase my salary to £1 million? You wouldn't do that, right? Because you instantly get fired. But that's what most of us do in trading. You just started trading, your first year in trading, you're over leveraging your account. You want to start making 10K a day, 100K a month, 1 million a year. And next thing you blow your account, and you will keep blowing your account, keep repeating the same cycle over and over and over again. If you can be very comfortable with making little, be consistent with that little. Figure out what you did that worked out to make you that little profit and how you can duplicate that over and over and 1,000 and 1,000,000 times over. That is how you become a profitable trader. So that's pretty much it on basically on the major things I wanted to teach you guys on in trading today. And anyone, if you have any questions, now would be the right time to ask, because the next thing I want to go into is just current market analysis. And after that, we'll wrap up. Does anyone have any questions? No questions at all. Awesome. So, so let's go to current market analysis. So last week, for people that tuned in, I told you about GBP US dollar and Euro US dollar. Now, another thing you need to understand is sometimes you do analysis, you mark out key levels, and price wouldn't mitigate those levels. That is the reason why you need to have. Now, you don't need to trade every single pair, but every week. Someone. Josh, you said you didn't say your entry criterias by time frame. I did. I did say my entry criterias by time frame. 4 hour inefficiency. You want to use a 4 hour inefficiency or fair value gap or daily fair value gap. Wait for price to tap it. Look for 30 minutes break of structure, 15 minutes break of structure. If you see that, you can take your trade. If you want to be a little bit more precise, when you see a daily fair value gap or 4 hour fair value gap, you mark it out, scale down to lower time frame like 1 hour. See if there's a 1 hour fair value gap there as well. If you can see a 1 hour fair value gap, that means you can use 5 minutes break of structure. I said it on this call. So this is an example right here. We have a 4 hour imbalance, very small imbalance resting right here. We scaled down to 1 hour and we looked at it and we saw that there was a 1 hour imbalance there aligning with the 4 hour imbalance. We want to buy from a discount zone below equilibrium. Price came down in there, mitigated it. We want to see a 5 minutes break of structure. It broke 5 minutes structure right there. 5 minutes break of structure right here. After that break, you get in, entry here, stop loss below this low. That's your first entry. You want to get in again for second entry. You want to see same time frame break of structure, which is another 5 minutes break of structure in here. If you see that, you take another trade. Use the new low as your stop loss. Add extra pips below, targeting the same direction. So if your first entry take profit is here, the second one take profit will be at the same zone. Does it make sense now, Josh? So, so let's go over to current price action and what I'm watching for the week. So take notes that the US shutdown has officially ended, which is amazing for trading because since we've had that shutdown, we haven't really been seeing some level of volatility, which helps the market move. There hasn't really been much high impact news on DXY, so which has been affecting the movement in the market. So, but the shutdown has officially ended this week. So what that indicates is we're going to see some level of volatility. Now, the pairs that I'm watching, if we look at, so let me take this off. Let me just use a different chart. So now this is what I do every week. I'll mark out my charts, look at a few pairs, and I'll look for the best high probability setup. I'm not trading everything. I just want one or two pairs that has good high probability setups. Mark my higher time frame points of interest, and I'll wait for price to mitigate. Sometimes you could wait and then only one of those trades could get mitigated, and one trade could give you all you need for the entire week. This way, I've realized that doing it this way has helped me to consistently make money from the market instead of trying to chase every single trade, trying to chase euro, chase GBP, chase USD card, chase gold, and then you end up making money here, losing it in the other one. That is not the right way to trade. So now looking at this so far, you can basically see that the trend here is still bullish. So my focus this new week, because we also have a high impact news on USD card. So my focus this week is going to be using a higher time frame point of interest. So I'm just going to mark out the point of interest that I'm watching. This one, this is a daily inefficiency that I'm watching because we have a high impact news coming out on, I think it's on Monday or Tuesday, can't remember, CPI on the card. So that could manipulate price and they could want to run liquidity. And what liquidity is easy right here, this. So unless the high impact news just spikes price up, then I won't be in this trade. But if it spikes us to come down here, run this liquidity, come down in here, next thing I'm going to do is to scale down time frame to see if that fair value gap on daily aligns with 4 hour. And right here, there's a 4 hour inefficiency aligning with that. So perfect. I can either use 30 minutes break of structure, 15 minutes break of structure. And if I even want to be much more precise, I can even go to 1 hour, and there's also a 1 hour inefficiency. So that simply means that if price comes down here and I see a 5 minutes break of structure, I can look for buys. And I can be targeting my 1:2, 1:3, and I can look for a higher time frame fair value gap or inefficiency and use that as an exit. So example, this is my higher time frame point of interest. So if price comes down in here, mitigates it, breaks lower time frame structure, I can look for a buy and I can be targeting for price to go in here. Now, it doesn't mean that I'm going to place my take profit here. This is another mistake a lot of you make. You put your take profit exactly at a high or an imbalance. Your take profit should be before that imbalance, before that high. Can you see what happened when we came very close to that imbalance? We started seeing retracement. So that means if your take profit was here, you'll literally be waiting all weekend. But if you had placed your take profit somewhere before even this high, somewhere around here, this is a low resistance. Use the lower end of that low resistance, this lower end. That's a perfect area for you to get out because that's an easy level. What you're looking for is easy level for price to go to. You're not trying to be the best trader in the world. You're just trying to make money. You're looking for the easiest level price will go to. Get in, get out, live with your money. Don't go back in again. We're on the sidelines. If you're able to consistently make just 1% every single week, that's 4% a month. On a 100K account, that's 4 grand. That's pretty much great. That's 48,000 a year. So this is my first trade that I'm watching for the new week. And if I don't see those criterias, if I don't see a break of structure here, either 5 minutes, 15 minutes, 30 minutes, or even 1 hour from down here, I'll just be on the sidelines. I'm not going to trade it. So the next one is I don't really like euro right now. I don't like the price action in as much as it looks great, but I don't like the price action on euro. Unless euro breaks above this daily high, I'm just going to be on the sidelines. So if it breaks above this daily high, then the market is giving me a telltale sign that it's ready to continue higher. So I can now be looking for a higher time frame point of interest, maybe daily inefficiency, 4 hour inefficiency for me to use as support to continue higher. So that's what I'm watching. Then GBP US dollar on the other hand. So for some of you that tuned in with me last week, I told you this is my point of interest on GBP last week, and that's an area I'll be looking for buys. And you can see how that worked out. You can see price came down in there, mitigated that position. And if you go straight down to all you want to see is a 1 hour, 30 minutes break of structure from that position. And you can see after it came down in there, mitigated that position, created a 1 hour high, 1 hour low, rallied, broke structure, retested inside an imbalance. All you got to do is wait for this retest. You don't even have to place your limit order here. You can wait for this retest, wait for a 5 minutes break of structure inside here, and look for your buy. And look right here how that played out as well. And look how price came down into that position. Came down in there, created a high, created a low, broke structure. This one right here, retested, gave you a buy. And even if you missed that, it came back the second time to give you another entry right here. Even if you missed getting in the first time, it came back the second time and gave you another entry. And if you bought it, this would have delivered a very beautiful 1:2. Like I said, you take that 1:2, you take it, you leave. Don't be greedy. Right here, this is your low. This is 21 pips. Add a few extra pips, 3 pips, 24. Target 1:2. And right here, this is 1:2. You get it, you get out. Be done. Don't be greedy. And that's it. Price literally came down in there, tapped you in, went straight to your take profit. And that's your trade. Some of you that were here last week, some took the trade. There was this guy, he took the trade and I was on a call with him, even though he's on my one-on-one as well. He took the trade and he made money from this. And he paid himself. One trade, just one trade. That was all he did. Nothing else. He didn't take any other trade throughout the entire week. Just one trade. So now, looking at GBP US dollar, if we look at GBP US dollar, you can basically see that here we mitigated the weekly inefficiency right here. This is part of the reason why I wouldn't recommend you holding any long-term buys. Short term, stick to short term right now. The reason I'm saying stick to short term is because of this shutdown that just got closed last week. I expect to see a lot of manipulation before the market can continue. So this mitigation here, they can still use this as an excuse and run this low to run out here because I'm still expecting DXY to edge higher. I'm still expecting DXY to edge higher this new week because right here we'll have this inefficiency. 1 second, I'm losing my voice. So, so on DXY perspective, we have low resistance here. And price took the first layer of this low resistance right here. And after taking this first layer of low resistance, we retrace into an imbalance on a weekly. So if we do see any significant break of structure from here, like 1 hour, 4 hour, that could be giving me an indication that DXY wants to edge higher to run out this high. And if DXY is edging higher, what do you think is going to happen? That means Euro is going to go lower. That means GBP is going to go lower, unless something magically happens. And then DXY just keeps going lower. So I don't like the price action personally. I don't like the price action, so I wouldn't really bank on it. I'm not going to try to buy anymore on GBP this new week. I'm going to be on the sidelines on this one. I'd rather prefer looking for buys on USD card for the new week than looking for buys on GBP. So that's my analysis on GBP. Another players that I'm as well, these are high probability as well. And so another one I'm watching for the new week is Bitcoin and Ethereum. And why am I so interested in Bitcoin and Ethereum? The reason I'm very much interested in them is because so far you can see 6 months were bullish, trending to the upside. And if we look at this on the 3-month time frame, you can already see that on the 3-month time frame, the market has been trending to the upside, consistently creating higher high, higher low, then higher high, higher low, then this high, this low, and then we'll have this high. So it's ideal for price to create a higher low before the next impulse move to continue higher. So if we go to the monthly time frame, you can see that on the monthly, we've already come into a monthly inefficiency. So I'm watching this monthly inefficiency. Price should break a 4-hour high from this position. That will be giving me a telltale sign to be looking for buys on Bitcoin to continue to the upside. So this is another trade that is very high probability in my opinion, not financial advice. And I'll be watching it very closely. So all you got to do is just mark the 4-hour highs and the 4-hour lows. So far, you can see this is 4-hour high, low, high, low, high, and then this is the low. So unless price creates a new 4-hour high and then a new low, this is the last 4-hour high that we have right here. And then this is the 4-hour low. So if price should break above or below, then I'll be interested. So this is the 4-hour high. I'll just remove this so you can see this clearly. So this is the 4-hour high, this is the low. If we break above this high, then that's a 4-hour break of structure. I'll start looking for buy opportunities for Bitcoin. But if it doesn't, and maybe it creates this high and creates a new low, then I'll put this line to this new high and this new low, and I'll be watching that very closely. So that's my analysis on Bitcoin and what I'm watching as well. Now, the next one I'm watching is Ethereum as well. So for Ethereum, so this is Ethereum. I'll just use this chart, remove everything here. Now, Ethereum as well, if we go to 3-month time frame, you can see 3-month time frame, Ethereum is actually bullish. And as much as this or this week's, this is a very volatile pair. Look at it on the 12-month perspective, you can see 12 months were bullish. So everything we're seeing is a retracement before a continuation to the upside. Now we'll take this to the monthly to make it a lot easier for us. And you can see that on the monthly, we created this high here, and then we created a low, created this lower high, created a lower low, and then we rallied to the upside, we broke structure. After breaking this structure, it's ideal for us to see a retracement, which the market did. And right here, it created a lower low, lower high, and then a lower low here. And then it broke another structure. So this is what I call same time frame breaker structure. It broke monthly structure twice. This is giving me a telltale sign that Ethereum really wants to expand to the upside. So if this is truly a retracement, the next expansion I'm expecting for price to rally exponentially well. So now there's something I call the quantitative analysis. I'm not going to go too much into that so I don't confuse some of you that are really new to my sessions. So this is 257%. So that simply means that once Ethereum finds a low, I'm anticipating for 128% move, worst case scenario to the upside. And if we measure that, you can see where that is going to take us to. Now, this is absolutely not financial advice. For some of you that will take this now and say, I told you Ethereum is going to 6,000. But watch that key level that I just outlined. Mark it on your chart. Don't place any trade. Do it on demo. Watch how that plays out. Look at the price tag, 6,924. This is not financial advice. I'm not telling you to go and buy Ethereum. John, you're taking notes.
Yes, sir. I need to.
So so a lot of these guys, like John, he's been in my mentorship. He's seen me call these prizes. Tell them.
Yeah, yeah, yeah. I have been in the mentorship and I'll just say that everything works out the way it's analyzed. But though, just like you said, not financial advice.
All right, cool.
Yeah.
So so now this is the point of interest I'm watching on Ethereum for this week. Um, right here, if we see a 4-hour break of structure from here, then I'll be looking for buy opportunities for Ethereum to continue higher. And what I outlined is going to be my next targets on Ethereum. So that's pretty much it from me today. If you want to join my group mentorship, because I'm gonna close the entry very soon. So if you want to join, it's only 27 pounds. And a lot of you here have already paid to join. It's 27 pounds to join the group mentorship. It's going to be for a month. We'll meet every week and we'll cover a lot of things on in-depth so you're able to know how you can get into trades, get out of trades, what to look for, entries, exits, and you can always ask your questions. The beautiful thing about my mentorship is in as much as we're meeting during the sessions, I'm still going to be guiding you during the weeks. You can ask me any question anytime. So John has been in my mentorship. He knows what it's like. You can reach me any day, anytime. If you message me, I'm going to give you a response pretty much within a few minutes or hours, depending on my availability on that day. So if you want to join, you can just go to the group chat. On that group chat, you could see the pinned post, but I'm just going to repost it right now in the group. So any of you that wants to join the group mentorship, just use the details to sign up, or you can just send me a DM and I'll just send you the details if you can't find it in the group chat. But any questions, you can drop it in the group chat as well, and I'll be there to answer them. So I'll just drop it there, the registration details. So I'm dropping it there in the group. So for any of you that want to join, feel free to use the information.
Okay, sir. Thank you so much.
Yeah, so I've dropped the details in the group chat. So you can see that, go through it, any payment details that work for you, choose that, and just choose that and make your payment and message me with with the receipt of payment. So I appreciate some of you that have already registered already. Votes, Mohan, Valerus, and so many of you, Ravi, and other people that have registered as well. I appreciate you all, and I promise you, you're gonna get the very best from this program. So I'll see you all in the next time we'll do another session. I'll see you all. But any questions, just feel free to leave it there. So take care and thank you for coming today, and have a wonderful weekend, everyone.
Thank you, sir.